Options are a broad category of different types of instrument. This video focuses mainly on call and put options, but binary options and exotic options are also available in some regions. Options are contracts giving the holders the right to buy or sell something at a predetermined price, usually at a particular time. Call options give the right to buy, and put options give the right to sell. The predetermined price is usually called the strike price. This is the price at which the asset is bought or sold if the option is exercised. Except in some specific cases, the holder of an option doesn't have to exercise the right to buy or sell. The time at which the option can be exercised varies widely, depending on the specific type of option. Traditionally, the main function of options is to ensure that a buyer or seller can receive a specific price for the transaction. In some respects, options are to deliverable assets what pending orders are to CFDs, but this is a somewhat crude analogy. In addition to paying a spread if an option is exercised as for CFDs, the extra fee for trading options is the premium. Options with earlier expirations or more distant strikes usually have lower premiums, while those which expire later or have closer strikes can have higher premiums, but there are some exceptions to these general rules. Options can be used for speculation, but doing this successfully usually requires very detailed planning. Assuming the equivalent potential gross profit, fees will almost always be higher for speculating with options compared to doing the same with CFDs. There's no particular reason for the average trader to prefer options to CFDs for speculation. Among other factors, the barriers to entry for options are much higher, and leverage is rarely available. Comparing options directly to pending orders for CFDs, it doesn't cost anything to cancel a pending order before it's active, but options always involve premiums, regardless whether they're exercised. For retail investors, options have been more or less superseded by limit and stop orders offered by most modern, popular stockbrokers. Limits and stops in this scenario function the same as for CFDs because they'll activate automatically when the price selected is reached, assuming they've not expired yet. Obviously though, you can't sell a deliverable asset unless you own it. This is a potentially useful way to circumvent the regulation of pure options, which in most jurisdictions is extremely tight, while keeping essentially the same function for the average investor.